information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.
Hello and welcome to Your Money, Your Call. I'm Julia Lee from Bell Direct. If you have a question about shares, our phone lines are open and we'd love to hear from you. The number's 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And joining me on the panel tonight, we have Ben Clarke from TMS Capital and also Radge from the Chartist. So let's start off by talking about what's in store in 2014. I mean, Ben, a lot of people on the market are nervous at the moment because of what's happening in terms of China and fears of a slowdown.
Yep.
What is it that you're looking at in terms of 2014 for the Aussie share market?
Well, I've been thinking about this over Christmas, and I really think that 2014 will be the year that of earnings growth. Like, we've had 18 months now of the yield play being the driving force. And although I think those yield stocks will be well supported and, you know, they're not going to totally fall away, I struggle to see the next leg higher in them because, you know, even at the levels they're at now, the yields relative to cash really aren't that attractive if you're buying them at these levels. So I think the market's really going to focus on companies that can grow their earnings this year and not so much on the dividends that they're paying. And, you know, coming into earnings season in February, I think that's the focus. So, you know, in terms of portfolios, we're potentially starting to skew them towards maybe companies trading on higher PEs, but also have good earnings profiles, and particularly, you know, and I know everyone's saying it, exposure to offshore where there are stronger economies, and exposure to a weakening US dollar, those sort of themes.
Yeah, that's something to really celebrate because the last 3 years we've seen no earnings growth for the market.
We haven't.
Finally.
And I don't think we're going to see a great deal potentially this year either. I think we will in certain sectors and certain companies, but I think the market as a whole, the earnings growth is going to be relatively anemic. And, you know, we've had the PE expansion going into this year, and there's only so far we can expand without earnings growth. So it really becomes probably more of a stock picker sort of year.
So I guess having a look at the market, and, you know, we're forecast to see earnings growth, which is really exciting from a fundamental point of view. But what about from a technical point of view?
Well, technically, we've been a little bit cautious over the last 3 or 4 months, and you've seen prices come off a little bit in the last week or so. Again, the small ordinaries is still continuing to struggle, and I would expect that's going to continue. US markets have had a phenomenal year. Now, historically, once the US market puts in a 27% year, like it's done, you generally have very much a reversion to the mean. Not necessarily a negative year, but certainly a much softer year. So I would suggest that for much of the Australian market that's been struggling this year, I think you're going to get a little bit of weight on the market from the US markets taking a breathe in 2014. So I'm expecting a little bit more consolidation, especially or still in the small ordinaries, which would put it probably into its 5th year of consolidation. Wow. Which is very similar to what we saw after the 87 stock market crash. So it's obviously a little bit of time necessary there, and I agree with Ben. I think the big end of town dividend stocks will be still well bid, but I'm not sure they're going to shoot too much higher. Okay,
so a little bit more cautious on 2014. Let's go to our first caller. We do have Terry on the line from Maitland. Terry, welcome to the show. What's your question tonight?
Oh, hi, Julia. Happy New Year, guys.
Happy New Year.
Thank you for taking my call. My question is a general question about what stocks do you think will benefit and do well in 2014, or stocks or sectors?
Perfect timing for a question like this. What stocks, what sectors are you looking at in 2014? I mean, Nick, you just mentioned that the small ordinaries looks like it's still going to consolidate. So you're looking at the mid-size part of the market to the large caps?
That's the area I tend to focus on personally. I guess saying that, it's quite interesting because it's been consolidating for so long. A lot of people have given up on that part of the market. And when you get that, I won't say capitulation, but I know there's people in that part of the market saying it's all too hard. Let's go into the high yielding dividend stocks because that's what's been going well. But chasing performance like that tends to work in reverse. So I think, as Ben said, those dividend stocks have had their run. If you're going to go there now, you're probably a little bit too late. And those that are pulling out of the small ordinaries, well, you've probably put up with the toughest part of the whole thing, and sod's law said it's probably going to go now. But we don't try and pick stocks. We just run with the trends, and if they're there, we ride them. And they certainly haven't been in the small ordinaries over the last 18 months or so.
Okay, so small ordinary is the place to be in 2014. We'll see. I mean, over the last month, we have seen the small odds up 4.3%, so that's around about double what the general market has done. But of course, over the past year, down by 6%, whereas the market's up by 13%. I mean, Ben, looking at the market, what stocks, what sectors catch you?
Well, I think healthcare is going to have another good year. You know, that was a sector we really spoke about last year on the show, and we still have a lot of exposure to a variety of healthcare stocks, and there's actually another couple we've been looking at in the last week or two that we're potentially going to start adding to. I think building materials will continue to move. So, you know, we own Brickworks and Dulux in that space, and I think they're set for another good couple of years. And financials, I think, will still do reasonably. And then, you know, as I was saying before, there are businesses we're looking at that have got operations overseas. You know, Henderson Group's an example of one that we own that is a financial, but it's a European fund manager. And I think the last 3 months of last calendar year were the highest flows of funds into European equities on record, which is quite amazing when you think, you know, how dire the whole situation over there looked only a year or so ago. That's where, you know, guys like Keir Nielsen are saying the value in the world is. So, you know, there'll be businesses like that I think will do well. So I don't think you can sort of take a market approach. It's really got to be, there'll be some areas that do well, and I think there are others that won't do so well.
Okay, so you mentioned the healthcare space now. That's not a huge space, but there is a huge divergence in the type of companies, whether you've got sort of the startup biotechs to some of the bigger healthcare companies like CSL, Cochlear. Which end of the healthcare are you looking at?
In the larger end. I mean, look, the small cap biotechs are doing very well at the moment, I know, but it's just too hard for me because the market sentiment towards that sector can move them around so rapidly, and they often just don't trade on fundamentals, and it's just too hard and not sort of what our clients are looking to achieve in terms of punting little stocks. So, you know, we own CSL, Cochlear, ResMed, Primary Healthcare, and there's a couple of others there that we're looking at the moment. You know, I think, you know, CSL in particular, I still actually think even at $70, it looks quite reasonable. And I'm sure they're going to have another good year. So, you know, we're still happy to buy all 4 of those stocks.
Okay, so the healthcare space. Now, Nick, I know that you trade based on momentum. So in terms of sectors and in terms of individual stocks, which stocks or sectors are catching your eye?
Well, Ben's mentioned a lot that I have myself. I mean, you know, the DLX, the HGGs, those kind of ones, they're trending very, very strongly. CSL we've had for 2 years now, and we'll continue to hold that. Interestingly enough, we just got out of Ramsay just recently on that pullback. So again, look, it could set up. If it keeps going, we'll just join that trend again. But there's certainly some nice trends still going around.
Okay, so the healthcare space looking pretty good at the moment. Let's go to our next caller. We've got Luke on the line from Brisbane. Luke, welcome. What's your question tonight?
Yes, hi Julia. Just looking at Rio Tinto, it's come back from $69 to around about 66. Can we see further downside?
It's a good question, and I think this is a question for Nick. Looking at Rio Tinto today, especially, we did see the stock coming down quite substantially. Is this a buying opportunity, or are we going to see more downside here?
Yeah, there's a good gap down there today on slight increase in volume. There's good support running through it around the 64.70. I would be concerned if it broke down through that. Look, it's had a good run. It needs a breather. If we can consolidate above that 64.70 for a month or so, that'd be very, very positive, and we could have a go at the recent highs around that 72, 73 level. But if we broke down through 64.70, I'd be just standing back a little bit at the moment and just letting it sort itself out.
Okay, so probably at an important crossroad in terms of technicals and just watching price action from here. I mean, Rio Tinto, a lot of concern in the market around demand coming through from China and the crackdown on shadow banking. Is this an opportunity to buy?
Look, I'm probably the most optimistic I've been on Rio in about 4 years, and it actually has been one that we've been chipping away at over the last couple of months. I think Sam Walsh is the guy that you want running the company. And if you read the articles, you really get a feeling that Rio used to be an incredibly conservative company. A lot of people wouldn't remember that because it just totally lost its way during the boom in resource stocks. But I think now about 90 to 92% of earnings comes from iron ore, and they've actually got the best iron ore operations in the world, better than BHP, better than Vale. And as so now it's really an iron ore game, and it's sort of similar to Fortescue. But the difference with Fortescue is they're the lowest cost producer in the world. They're still producing under $50 a tonne, and there's plenty of room there. So, and I think they're finding lots of areas to cut costs, sell non-core assets. The dividend will start to ramp up in a couple of years. So I'd actually be pretty positive on it. But you've got to watch the iron ore price, of course. You can't just buy it and stick it. Resource stocks, I still think, are trading stock. You've got to be more active in them. They're not buy and holds. And we've seen the resource boom, and if it's taught us anything, most of them are trading at a half of what they were before it even started. So hasn't been much value created for their shareholders.
So most things moving in cycles. We've just got the Rio Tinto share price chart up there, and you can see it's been a nice upward-looking trend coming back to that support line. And Nick's saying just watch that support line to see that Rio Tinto does bounce off that. Otherwise, we could see weakness. But Ben's saying he's the most positive on Rio Tinto that he's been in around about 4 years. And on that note, we are taking a short break. We'll be back to answer more of your questions in just a moment. We have got Michael on the line from Melbourne. Michael, welcome. What's your question tonight?
Hello, Julia.
Hi.
Thanks for taking the call, and Happy New Year to all and your panel and that there. I've got a couple of questions here, both technical and fundamental. First one's Quick Step Holdings, QHL's the code.
Sure.
They're in composite manufacturing. I've had this stock for a while, and I think they've probably got a little bit of future, so I'll be interested in the fundamental analysis of that particular company, plus maybe a chart from Nick.
Sure.
And more particularly Telstra from Nick. Thanks for your site too, Nick. I'm a subscriber to you, and it's a really good site. Telstra approaching their 10-year resistance levels. What's your thoughts about them getting above it and going on? They're the two questions. Thanks, Julia.
Questions. Let's start off with Telstra, Nick. Telstra's one that a lot of Australians hold, a lot of viewers hold. It's been doing very well on the market in 2014. What do you think?
Yeah, we've had Telstra in our momentum model since late 2011, so it's been a nice ride. Michael, it's one of those stocks where we've come a long way, and it's spent pretty well half of 2013 moving sideways, which is a very positive thing, and it's now just breaking out to those highs that you mentioned. So it looks really good to me. It's you can't argue with a stock that's making, well, almost 10-year highs. So got to stick with it. Trend is firmly up. Higher highs, higher lows. There's no reason to be turning around and selling that yet.
Okay, so trend is up for Telstra. I mean, it looks like they're selling their Hong Kong CSL.
Yeah, CSL, yeah.
And that's going to be giving them a bit of money.
Yeah.
What are they going to do with the money?
Well, and the other thing they've done, which is really interesting, is there's this business in America that's floated called Auto Home, which is like a Chinese car sales. Telstra owns 67% of it or something. I don't know how they got it, but they do. And I think I last saw Telstra's stake in it. It's now worth $1.7 billion. It was up 76% the first time it started trading on the New York Stock Exchange. So I think between those two stakes, there's Telstra is suddenly flush with cash. And I saw an analyst today was saying he reckons they could do a $6 billion on-market buyback, over coming years. But clearly, the fundamentals are improving. The only caution I'd have is that at 5.30, Telstra's on a yield, including franking credits, of about 7.5%, and there hasn't been much earnings growth. Like, what I was saying at the start of the program, the earnings growth has been minimal from the company for years and years now. And although the balance sheet looks good and there might be some capital coming back to shareholders, I'd probably be a bit more cautious on it now at these levels. And I struggle to see it getting into it on a yield of the high sixes, for example, which would mean that I can't see probably too much more upside over sort of 5.45, 5.50.
Okay, so lots of cash but no earnings growth, so not that attractive.
Well, sort of 3 to 5%. It's probably keeping up with inflation, the earnings growth.
Yeah. What about Quickstep? QHL is a stock code. It is a smaller company, market cap of about $100 million. What is it?
Well, I can't really give too much of a fundamental. I know two things about this company. First is they build like this tiny little part that the Americans have licensed or have asked them to produce for their newest US fighter jets, which is just such a crazy sort of thing that an Australian company is doing that. And it's literally, I think, one little panel on these planes. But they're big contracts. I think they're like $60 million contracts. I think they just got awarded a second one. I know Sol Patts, which is a business we have got a big holding in, have invested in this for a while, which I think is probably a good vote of confidence in the management. But any more than that, I really couldn't say, to be honest. I haven't looked at the company too closely.
Just having a look at their last announcement, they've signed a $75 million contract with Lockheed Martin to supply wing flaps.
Wing flaps.
Well, they're important.
Yeah.
For their,
Planes need wing flaps.
for Super Hercules military transport aircraft. By the looks of it. I mean, technically, it's been a little bit all over the place, but the second part of the year, it's been doing quite well. What do you think, Nick?
Yeah, an interesting stock, Michael. It was in a basing pattern there from most of 2012 and half of 2013, with the top end of that base around 20 cents, and we broke up through that sharply earlier or mid last year, and we're now sitting above that. Quite a volatile stock. Historically, it does put in these big spikes and come straight back again. So it's not particularly a nice trending stock at all, but certainly some positive momentum behind it at the moment. Consolidating above that 20 cent support. I guess if you wanted to be aggressive, you could lean on that. That is, buy against that support, place a stop loss under it, and see if you can't get some upside momentum. But as long as it stays above 20 cents, looks okay.
Okay, so there's the technicals and the fundamentals. Two very interesting stocks, one on the large cap end, which is Telstra, and the other one on the small cap end, which is Quickstep, QHL being the stock code there. Let's go to our next caller. We've got Bob from the Gold Coast. Bob, welcome. What's your question tonight?
Good evening, Julie. I love your show.
Thanks, Bob.
TPG, it just seems to be going up and up and up.
Absolutely. I mean, today was a record for the company, an all-time record high. We've never seen the stock price at these levels. So let's go first to a technical view. Nick, what do you think of TPG?
I've got it myself. We've been riding this one off and on, Bob, for a couple of years now. When it was back down around the 158 mark, we're 550 today. The stock at all-time highs. I mean, it's doing the right thing. Why sell it? So it looks good. I own it. It's probably going to go to $10.
So TPG looking good technically. I mean, fundamentally, it's starting to look expensive. A PE ratio of 30. It's in the telecom sector, which typically trades at lower PE multiples, not higher ones. What do you think of TPG from a fundamental point of view?
Well, it does look expensive, but I mean, you know, the CEO, David Teo, he just cannot put a foot wrong in terms of what he's done with this company, and, you know, making right acquisitions at the right prices. He's got this incredible plan to roll out effectively a mini NBN in a lot of the capital cities, starting in Sydney, which really actually could throw a huge fork in the NBN's plans in terms of what they're doing. So that'll be interesting to watch. I mean, if I was in it, I'm not in it. Sol Patts, you know, I was talking about before, they own 23% of this company,
Well, Sol Patts must be doing well. They've got Quicksteps,
they've got New Hope,
TPG.
unfortunately. Coal's not so good at the moment, but still. I'd stick with it as well. I think, you know, great quality companies trade on high PEs, and you've just got to sometimes, I think, just get past that. And as long as you're confident that the management's doing well, and you've got a long enough sort of time frame, then I'd stick with it.
Okay, so sticking with TPG, looking good from a technical point of view, and we're going to take a short break, but we'll be back to answer more of your questions in just a moment. Stay with us. Welcome back to the program. If you have a question about a stock or shares, our phone lines are open, and the number to call is just on your screen there, 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And we've got Tony calling in from Brisbane. Tony, welcome. What's your question tonight?
Hi, Julia and team. How are you?
Good. How are you doing?
Good. Hey, look, just a question on Sonic Healthcare. I've been a long-term holder of Sonic, and just wondering how it's going. I've heard that there's some theory that it may be going to do well out of a fall in the Australian currency, but wondering whether I should be looking at switching to Ramsay or one of the other healthcare industry stocks.
Sure. So having a look at Sonic Healthcare, SHL is a stock code there. Now, Ben, I know you said you like healthcare stocks. Is this one of those ones that you...
It's actually not, Julia, and it's done very well despite that. Look, I think Sonic's doing well. The thing I'm just a bit cautious on is they've got quite a lot of exposure to Europe, where they do a lot of the pathology and radiology sort of work. And I've always just in the back of my mind sort of worried that with the state of the European economies and government spending, that there might be some sort of cutbacks in fees, etc., paid out of the healthcare system for those sort of things, which we have seen happen in Australia. So, but I think when you see that big pullback there, there was 2 of Sonic's competitors in the US, both had profit downgrades, and Sonic actually came out and said we're actually doing quite well overseas. So that only happened a couple of weeks ago. So look, if I was in it, I'd probably stick with Sonic. I think they're probably going to report a reasonable result. The one I probably prefer in that space is Primary, which also is in radiology and pathology, but it's a much smaller part of their business and it's local. But medical centres is the larger part of their business, which I think is a really good business. It used to be a great business for them until they bought Symbion and nearly killed themselves for about 3 or 5 years. But we started buying Primary over the last year, and their last year they did 21% earnings growth, I think, and they've guided, I think, for 13 to 16% earnings, or 8 to 13% earnings growth for this year, which is pretty healthy. So, that's the one we prefer.
Okay, so Sonic, if you're in it, stay in it, but prefer Primary healthcare. How about you, Nick? What do you think?
Well, Sonic, it's interesting you've brought these stocks up. Tony, I mean, Sonic is quite a volatile stock. It had that big sell-off a couple of weeks ago, or a couple of months ago, as Ben suggested. But when you look at it against Primary, Primary's had that big consolidation phase now going on almost a year, and generally that's a good thing. It trended very well into that. It's now resting and ready to break out, and for breakouts you probably want to go with that. But Ramsay, the one is the one belting along, and it hardly had missed a beat on that sell-off a couple of weeks ago, and it's just been an exceptional trend. So, 2 different kinds of personalities there, although they're both trending in the same direction, but Sonic's certainly a lot more volatile and maybe a little bit harder to stomach.
Okay, so that was Sonic Healthcare and the healthcare space. It is now time for a viewer email, and let's go to this one from Les. And Les writes, "Hi, Cash Converters has seen a pullback from its recent rally. Can the panel advise whether there's significant value in the stock?" Oh, that's a big sigh, but Ben, what do you think?
I'm not particularly sure. We don't own Cash Converters, although I do think it's a good business. They had a positive announcement recently. I've got to say, it was where they bought a chain of the New Zealand stores, and I think they'll probably do well out of that. But it's not a stock that we're in at the moment.
Okay, it's time for a break, but we'll be back with more after this short break. If you'd like to speak with our expert panel, please give us a call, 1300 30 34 35, or you can email us at yourmoney@skynews.com. Welcome back to the program. Joining me on the panel tonight, we have Nick Radge from the Chartist and also Ben Clarke from TMS Capital. So if you've got a question you'd like answered, we'd love to hear from you. The number's 1300 30 34 35, or you can email us on yourmoney@skynews.com.au. And just before we went to the break, we're talking about Cash Converters, and this is actually quite an interesting one because we know that they announced a class action in the last quarter of 2013. Doesn't really explain how sharply the share price has fallen away. I mean, Ben, what are your thoughts on this?
Oh, the only other thing I'd probably say is I think there's a lot more competition emerging in this space. The payday lenders, and you see the ads on TV all the time. You can get $1,000 with, in 24 hours, which, is a big part of Cash Converters. They're effectively a pawn store, and it is a big part. People who need quick cash. That's how they make money. So I think there's probably more competition. I also think the banks are lending a bit more freely than they used to in the past as well. So maybe people don't have the, sort of the Cash Converters was the dominant player in the space.
Nick, what are your thoughts?
Yeah, interestingly enough, where prices are coming back to now, second quarter last year, we dropped from 160 odd down to 80 cents. And when we hit that 80 cent mark, we saw some very big buy demand come in. Now, interestingly enough, that's the kind of area we've come back down to again this time around, and we're slowly trying to bounce. So it could well be that there's some buy demand down around this 80, 85 cent area, and that might offer a bit of support. But generally speaking, the damage that's been done, we want to see some sideways consolidation and a few more sellers get bored of holding the stock and exit. And once that's done, once that supply has been alleviated, then potentially the stock can rise. So support at 80 cents, I would certainly be concerned if we broke down through that, because that's quite a significant level.
It's an interesting stock, Cash Converters. It's been through the ringer over the last 3 months. But that's the fundamental and the technical view. Let's go to our next call. I've got Glenn on the line from Sydney. Glenn, welcome to the show. What's your question tonight?
Oh, hi, Julia, and Ben and Nick as well. Look, Julia, continuing on with the healthcare or the biotechs, my question is in relation to Resonance, RHT. Now, I've noticed that this stock has a particular software that relates to MRI, imaging, and with the fat in the liver, and apparently, with the FDA approval, this seems to be a fairly good story. I've got into it recently. It shot up and it dropped back a little bit, and I got into it at that stage. So I'm just wondering whether the other guys know about that stock.
Sure.
And if you've got any time, do you think QBE's clawing its way out of this hole after suffering a dagger to the heart? Thanks, Julia.
Let's start off with Resonance. RHT is a stock code, and we've just got the stock chart up there. So let's go to Nick first. I mean, the share price has just absolutely shot up. How do you manage a position like this?
Yeah, well, this is one of those highly speculative kind of stocks. I mean, it's basically done absolutely nothing from 2006. Interestingly enough, the point at which it's now shot up to was a very major level of support extending all the way back to 2004, 2005. So old old support becomes new resistance. That's where we are now. The secret here, Glenn, is watching where the closing price is on a daily basis compared to the volume. Now, for example, today, we had a high today of, what did we get up to there? 9.6 cents, but we closed quite a bit lower than that and on very, very high volume. And that means sellers are coming in. And that makes sense. The stock's gone from 2 cents to, 9 or 10 cents very, very quickly. So it makes sense that people want to take that profit. So generally, when there's profit taking about, that will manifest on itself and continue, and that probably means the stock's not going to go too much further in the very near term unless it gets some more news. So once those sellers are out of the way, then potentially look to buy another breakout. But quite volatile. It's moving around, a lot, as you'd be well aware.
Yeah, moving around a lot. It's a small stock, but it's an interesting story. I mean, at the moment for fatty liver, the gold standard is a liver biopsy, and that sounds kind of painful and really inconvenient. And the technology that Resonance has looks like it's an MRI to measure how much fatty liver there is. So if you've got a drinking problem or a bad liver problem, so it's an attractive sounding story. They've just got an FDA clearance for market clearance for the HepaFat scan. HepaFat scan. Ben, what's your thoughts on this? It's a tiny company.
Yeah.
I doubt a lot of people have heard of it. $26 million market cap.
Well, I mean, that's a pretty small market cap for a company with FDA 3 approval to start marketing and sell. So that sounds quite good to me. I guess the only note of caution I'd have is, number one, and I don't know the answer to this, is do they have enough cash to get through to selling their technology? And number two, I would say, is that this timeline of getting an international partner to probably market and handle the sales and they get a royalty stream out of it, it always takes longer than you think it's going to, and the excitements can sort of come out of it. But I wouldn't we get asked about a lot of these sort of companies, and someone who's actually got through to being able to sell their product and their technology, actually that actually sounds quite optimistic to me. And I'd probably stick with it if I was in it. I'd normally be more cautious than that, but that's because normally there's still 2 or 3 FDA trials to go. They're going to need to raise huge amounts of extra cash, and it's a long sort of path until they're ever going to make any money. Whereas this one, within 12 months, it could be getting money coming in through the door.
Okay, so watch this one, especially if their product hits the market, and it's a massive market. I mean, liver disease is a problem not only in the US, but also in China, 2 of the biggest markets in the world. It's an interesting one. The other question was around QBE, which, the macro factors are going in its favour. You were seeing longer-term bond yields rising, US dollar strengthening, which is great, but then we had that profit downgrade in December. Yeah. So what are your thoughts on this one, Ben? Is this a golden opportunity to be getting in?
Well, we've had several, haven't we? And then we suddenly find out it wasn't so golden. I mean, I was on the analyst call with John O'Neill, and I think I've said on another show already, the frustration from the analysts was just palpable, and you know, a lot of these issues that they found in their long tail insurance book in the US just came out of thin air, and just a huge amount of frustration after being told by management that 2013-14 was the transformational year. This is the year we're really going to really start to do well, and then this comes out of left field. I would say, and what we said to clients, because we own QBE, is we said on that call that a number of analysts were saying to John that we still can't get our heads around the guidance that you've given, even with the issues that have happened. And the feeling was that they've just been way too pessimistic in terms of giving guidance, because they want to be 150% sure that they're not going to have another downgrade. So I think it probably is a buy. However, another problem could come out of a European long-tail insurance book that none of us are aware of, and he isn't probably even aware of, and the actuaries haven't been brought to his attention, and that's the worry, you know. But for the moment, we're sticking with it. That might change, and we did add a bit to it on the sell-off, but I wouldn't say I'm 100% confident with it.
So looking, well, the return probability of it is probably looking pretty good. It's already up 20% from the lows that we've seen after that profit downgrade. Would you be sticking with it, Nick?
This is the exact same situation that we saw in January 2012 and again in November 2012. It's the exact same price, a strong level of support, being supported by strong buyer demand at the exact same levels. I agree with Ben. I think this is probably a low point. I'm not saying it's going to go screaming higher from here, but we saw significant capitulation, exactly what we saw in late 2011, and again exactly what we saw in October 2012, and that's followed by a good buyer demand coming in, buying the dip. So I think the insiders are in here buying it again. It's going to trade the range, and probably over the next year or so probably trade up to where it's just come from, exactly like we've done before. So long as it holds $10, I think it's great down here. It might trade sideways for a little while, but I think most of the damage has now been done.
Okay, so long term, targeting $16, $17 again. It's around the $12 mark at the moment, or getting to that $12 mark, finishing at $11.87. It is now time for a break. We will be back with more in a moment. Welcome back to the show. If you have a question you'd like answered, please pick up the phone. Our number is 1300 30 34 35, or you can always email us on yourmoney@skynews.com.au. And we've got Rob on the line from Melbourne. Rob, welcome to the show. What's your question tonight?
Yeah, hi, Julia. I'm just looking at the panel's technical and fundamental view on two stocks. One is 7 West Media, SWM, and REA Group, ticker code REA.
Sure. So having a look at 7 West Media and REA, and let's start off with the technicals for SWM. Nick, we've just got the chart up there. What are your thoughts?
Yeah, Rob, I mean, it's been trading sideways, as you'd be well aware, for all of 2013. It trended nice through 2009, late 2012, and it's just been moving sideways now. I'd like to see it get up through that 250, 260 area before I join in. At the moment, it's a bit of no man's land. So if you can be a little bit patient, perhaps wait for that momentum to come in, break that line of resistance. If we can get up through 260, your next point of target is around that 375 area. Trends very, very well when it gets going, and the fact that we're going sideways now for this period of time is a good thing. So just be a little bit more patient. The risk in getting in here is we stay in the range and we just rotate backwards and forwards. The bottom end of that range is around the 185, 190 level, and the upper end of that range is 260. So that's kind of a bit of a no man's land in there for the moment.
No man's land, probably a good way to describe how media stocks have gone in 2013. Are you positive that going into 2014?
Yeah, I think I'd be reasonably positive. I think that, you know, the more cyclical areas of the economy that hopefully the areas that will do reasonably well, and you know, I think they will have some decent earnings growth. I guess Nine, you know, a revitalised Nine seems to be making a comeback, and that is a threat to 7. But they've got the old West Australian newspaper in there as well. Look, it used to be a great yield-paying sort of conservative investment. It changed incredibly under what Kerry Stokes did with it. I keep a close eye on it, and it could have a reasonable year next year.
Okay, so looking interesting. What about REA Group?
REA is it's a frustrating stock for me because I've always thought this is just one of the best businesses, and I've always looked for that pullback, and when it's pulled back I've thought maybe there's more in it, and it's bounced, and I think I've just missed it again because the CEO and the CFO both just left, which can't be good for a company that's trading on 35 times earnings, and it got down to 36, and I was thinking this is it, I'm going to get it finally, and of course I think it put on 5% today, and it's nearly
$39.25.
$2 off its high. I mean, look, it is an extraordinarily good business. Like, if there's any business on the market, this would be the one I own. I'm just paying 35 times earnings. It's a big sort of leap. So, Seek's one I've spoken about the last couple of years. That's the one in the space that we've got a lot of exposure to, and a similar business, just in a different market. And I hope REA you give me an opportunity to get into it at some stage.
So looking to get in at a cheaper price, but haven't been able to. Will it go cheaper, Nick?
Yeah, well, it certainly trends, Rob, when it gets going, and a sign, as Ben said, of a very, very good business. So, look, it's pulled back a little bit. I'd like to see a little bit more consolidation here. 34 is your magic line in the sand. 34.70 actually is your magic line in the sand. If we can stay above that, all continues to look positive. If we broke down through that, I would be a little bit concerned that some kind of a significant high has been put into place. But at the moment, it's looking okay. It's coming back to fill that gap. So if we can get on with and break out to new highs, you just want to have to go with it.
Okay, so that's REA Group. Let's go to our next caller. I've got Abe on the line from Sydney. Happy New Year, Abe. What's your question?
Thank you, Julia, and Happy New Year to you.
Thank you.
I'd like to ask the panel opinion about the performance of the energy stocks in 2014. Especially with the view that U.S. shale gas is going to be exported. Is there a threat, an immediate or in the medium term threat to our energy companies? And also about Leighton in particular, does the panel feel that there's an upside to Leighton in view of the infrastructure that's going on?
Sure. I mean, a very interesting question regarding the energy space. We're seeing the US becoming self-sufficient in terms of energy needs, and I guess there's a bit of different opinion in the market. On one hand, people believing that oil prices are going to be lower because of the shale gas story and the US being self-sufficient, and on the other hand, other analysts saying the demand's still there, the demand's still strong, oil prices are still going to stay relatively high. And then separate from oil is the whole natural gas story, where natural gas prices have been going absolutely crazy in the US because of what's been happening in terms of the weather over there, where it's freezing, and of course gas in Australia being huge. So lots to talk about. I mean, we have Oil Search's share price graph up there. So Nick, we might just start off with you. It has been falling over the last quarter. What are your thoughts on this one?
Doesn't do a great deal for me, I'm afraid. It's a choppy kind of a stock, doesn't trend particularly well. Hard for us to stay in it when it gets going. So don't really like it from a trading perspective. You're quite right, it's pulled back. I would only probably look to join it if it settles above $7.50 and finds a bit of a base there. You might want to trade that, lean against that support. Alternately, you've got some resistance up there around that 875. So at the moment, kind of mid-range. Short-term trend is down. Long-term trend is probably now in a consolidation phase or moving sideways.
Okay, that doesn't sound good. I mean, looking at the energy space, do you like Oil Search? What would be your picks?
I don't mind oil. I'm not really like a big fan of the energy space, to be honest. It's not an area. And I'd say to Abe is, firstly, nothing in energy happens rapidly. So I don't think there's some imminent sort of fear that you need to have that the US is suddenly going to start sending these. When you speak to guys in the industry, when they talk medium term, that they say that's 20 to 30 years, whereas medium term we say is probably 3 to 5 years, something like that. These things will change, like global forces and all that stuff. It will take a long period of time, and some of these projects will get through and be very profitable for a number of years before slowly things start to change. I just think that energy, I think prices I can't see the price of oil suddenly taking off, and gas is linked to the price of oil. And I just think they're probably sort of range bound because there is a lot more supply being discovered. You know, it's funny, like I saw something that on peak oil for the first time in like 4 years the other day. And the thing, of course, that happens is when we get close to peak oil, a new technology is invented, like fracking, which enables huge new deposits to be discovered. And there must be rising demand because the world's economies are recovering, but there's rising supply as well. So I just can't see from a pricing point of view that things are going to do too well. And you know, there's still lots of issues with costs with a lot of projects. So I don't know. I actually quite like Oil Search though. Like I think if I was in one, it would be in the mid-tip sort of sector. That would be it because they are coming into production out of Papua New Guinea. This has been a project years in the making, and if they can get another LNG train up, that'll give them a re-rating. So I'd stick in it.
We've only got 30 seconds left. Let's have a look at Leighton's. We might go to Nick first on a technical view on Leighton's. It has just bounced. Can it sustain that bounce?
It doesn't look particularly pleasant at all. Good strong line of support running through there. What's that? Just above the $14 mark, 14.60, 14.50. It's bounced off that a few times, but really trends down at the moment. We're range bound. I wouldn't be touching that unless, you know, we can move, you know, probably up above $20, and we're a fair way from that at the moment.
So not looking good. Just very quickly, Ben.
It's a trading stock now. We're not buying it. It's the biggest mining services company in Australia, which isn't good, but the infrastructure spend will be good. So make of that what you will.
Welcome back to the last segment of the show. We do have our next caller on the line. We've got Andrew from Canberra. Andrew, welcome. What's your question tonight for our panel?
Well, g'day, Julia. I love the show.
Thanks, Andrew.
Just a couple of stocks. The first is VLW, and the second is IPP. I'm a technical trader, so I'm liking the setup for both of these. So I'd just be interested about any fundamental information you might know. So those two, that'd be great. Thank you.
Let's start off with Villaworld. I mean, you know, the residential property market has been doing well in 2013, and this stock's followed that trend upwards. Nick, having a look at this chart.
Well, it has been a very, very strong year. So this sideways price action that we've been seeing for the last three months or so is very positive. So Andrew's got it right. You know, I think he's just been patient there and look to buy the breakout again or add to positions on the breakout. So just a little bit of patience here. It's just having a rest, and that's a good thing.
So looking good. I mean, Villaworld, it's up 160% over the past year. Would you still be buying it, Ben?
You know what, I probably would, because they own huge land banks in New South Wales and Victoria, and a lot in sort of southwestern New South Wales, Sydney, where plots off the plan are selling like absolute hotcakes, and they're sitting on assets that no one put any value on, and suddenly are going to be worth something because they're selling them off for decent amounts of pop, and they're going to build house and land packages on them. And the way that the housing market's going in this city, you would have to say that there's still a very good future for them. So I'd stick with it.
Okay, so yes to Villaworld. Now, what about IPP, iProperty? I know this is one that you like, Ben. You've spoken about this one in the past.
Yeah, I mean, my frustration with REA sort of comes down to this as well, because Jeremy, who I work with, Jeremy Hook, who's been on the show a fair bit, he bought a lot of this stock down at about 60 or 70 cents, and it's been an incredible performer. I didn't buy nearly enough of it. And this is the REA of Asia, Hong Kong, Singapore, Malaysia and Indonesia. And they're cash flow positive. They'll probably turn their first profit this year. The bloke who's running them was the general manager of realestate.com from 2003 to 8 and is very impressive. And, you know, if you look at what REA's done, if they get it right, this could be an incredible performer. So the other one that we're quite keen on is iCar Asia, ICQ, which is their car sales equivalent in those countries. And car sales has actually taken a 20% stake recently in it. So emulating the Seek model of trying to, you know, build these websites offshore. So it'll be interesting to see how they go.
So still buying IPP at these levels?
Look, I think we probably would be, but I think the easy money's probably been made, and I wouldn't expect the sort of returns that have been occurred this year.
Okay. And Nick, from a technical point of view?
Almost exactly the same picture as Villa World. You know, I've had a good run up through 2013. The last quarter we've been consolidating, just moving sideways, having a rest. Looks great. If it can break up through 208, 210, you'd go with it again.
Okay, so looking good for both Villawood as well as iProperty. So our last caller of the night, two very good stocks from a technical as well as a fundamental point of view. And on that note, that's all we have time for today. Thanks so much to our guests tonight, Nick Radge from the Chartist as well as Ben Clarke from TMS Capital. And to you, our viewers, for all your calls and your emails. Until next week, I'm Julia Lee from Bell Direct. Have a fantastic night.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.